The second step here is maintenance. All right, so now we have to maintain this asset now that we have acquired it. So maintenance costs fall into two categories: capital expenditures or revenue expenditures. All right, capital expenditures means you're going to charge an asset account, which means you're going to debit basically the asset. You are making some sort of significant improvement when you capitalize a cost to an asset. So let's say that I'm getting ahead of myself. Our journal entry then is going to be to debit that asset account, whatever it is that we're fixing, and credit cash. You're going to be, how do you decide if something is a capital improvement? Well, the idea is that it's significant. It is a major improvement. So the easiest way to think about it is like a vehicle. If you have a car and you put a new engine in the car, that is a significant improvement. It has increased the value of the asset. It has increased its life, maybe even its performance. If that's the case, sorry, I'm trying not to sneeze. If that's the case, you are going to be debiting the asset, increasing it. So if it costs you $5,000 to put a new engine in the vehicle, you're increasing the value of the vehicle. You're capitalizing it. So that debit is to the asset. It's like I said, you're adding a feature, you're extending its life. It's some sort of significant major improvement. All right. Alternatively, you have revenue expenditures. Revenue expenditures are things like your oil changes. Routine, regular maintenance that you would have on your asset. Maybe you're painting a building. That's maintenance, right? That's expense. If it was something that was really, really expensive, like you're putting a new roof on, no, that's more than routine maintenance, right? So that's a capital. So, just kind of think about it as that. In this case, the journal entry would simply be a debit to repair expense, maintenance expense, something like that, and a credit to cash, like I said, for like an oil change. All right. Oop, getting ahead of myself. Same entry. There you go. Maintenance expense cash. Okay. That's kind of it in the capital revenue maintenance conversation. So now let's move on to depreciation, which has a lot more going on in it. What is depreciation? We keep talking about it. The best way to say what depreciation is you're allocating the asset's cost over its useful life, to expense over its useful life. So if you're using a car for its useful life of several years, you're going to apportion an expense of using that car over the lifetime of the car. So if the car is going to last you for 7 years, you are going to take that asset and divide it. We're going to do the math, don't worry. We're going to divide it by 7 years, basically, and we're spreading the cost of that asset over those years. So is the asset losing value? Yes, but that's not really the true definition of depreciation. Depreciation, the point of it is to allocate the cost of that asset as we're using it over its useful life. All right, again, matching principle, matching expenses against the revenue, right? Okay, so the good news about depreciation is it's always the same journal entry, always. It's a debit to depreciation expense and a credit to accumulated depreciation. That's it. Now it might be depreciation expense building, depreciation expense car, depreciation expense, I don't know, what else? Computers. But ultimately this is the journal entry, debit depreciation expense, credit accumulated depreciation. All right, and the way you would list an asset, let's say you had equipment, right? And you've been depreciating that equipment. So if you were on the balance sheet here, you would have the asset, the long-term asset, and you'd have the equipment cost, and you'd subtract the accumulated depreciation from it, right? Remember that contra account? We talked about that a little bit in earlier chapters, chapter 3, I think. The idea is that you take the value of the asset, whatever you paid for it, and you subtract whatever the depreciation has been on that asset over its life. That's called accumulated depreciation, right? So the equipment minus the depreciation on an asset will give you really what it's worth to you today, which is also referred to as the net book value. Don't worry, we'll get to it with numbers shortly. All right, so the main depreciation method, straight line. Most common, most businesses are using that. Why? Because it's easy and it's straightforward. It's probably not the best depreciation method, but it is the easiest, which is why it's the most popular. Units of production takes a little bit more work, but it's a little bit more accurate. And double declining balance, Oops, too far. Double declining balance, we'll get to it. That's the one you use if you want job security because it's a pain. All right, but it is a valid method. All right, so a couple of terms for you guys. Residual value, which you may not have heard yet. Residual value is the estimated value at the end of an asset's life. You may hear residual value. You may hear salvage value. You may hear scrap value. You may hear trade-in value. I think that's all of them. All of them mean the same thing. The idea is, what is the asset worth at the end of its useful life? So we're talking about a car. Let's say you've been using the car for the 7 years, but you plan at the end of the 7 years, you fully plan on getting rid of it, but you expect to be able to sell it for $1,000 for scrap. That $1,000 is its residual value. It's leftover value, basically, when you're done using it. And useful life, how long do you plan on using it? If you plan on using the vehicle for 7 years, that is the length of service, right? Again, it's an estimate, and it's hard to make these kinds of estimates sometimes. All right, so let's look at straight line depreciation. So here we've got kind of an example. Straight line depreciation, guess what? It doesn't change. Once you calculate it, I mean, we can change it, but in general, once you calculate straight line depreciation, unless there's some reason to make a change, it is the same amount of depreciation every single year. All right, so it doesn't go up, doesn't fluctuate, doesn't go up, doesn't go down. Same thing. All right, so here's the example. The best way to show you depreciation is to do it with some numbers. You've got equipment that cost you $17,000. Its estimated life is 5 years, and the residual value, the value when we're done using it, is $2,000. This is the formula for straight line depreciation, okay? And it gives you the annual depreciation amount, meaning the amount for the entire year. So it's the cost of the asset minus any residual value over however many years you're going to use it. So you can split it up here. This cost minus residual value piece actually has a word, has a term. It's called its depreciable base, all right? Depreciable base. Not that you're going to test you on that, but I don't want you to not have heard a term, right? So the idea is cost minus residual value, the numerator here, is the depreciable base. Basically, how much are you going to depreciate of this asset? So throwing these numbers in here, you've got $17,000 minus $2,000, right? That's what the asset cost you minus its residual value. So you're going to depreciate $15,000 of this asset. You're going to depreciate right up to the residual value, and that's where you're going to stop over the number of years, which in this case is 5 years. And that winds up being $3,000 per year. That's going to be your depreciation expense. $3,000 every year, right? That's the idea of straight line depreciation. So in the income statement, you're going to have depreciation expense for $3,000. Okay, depreciation expense is going to be the same every time, right? So you've got $3,000 for year 1. Well, guess what? Year 2, year 3, year 4, year 5, you're going to have $3,000 every year. So in the income statement, every year, you're going to have this depreciation expense. So you have that journal entry, debit depreciation expense, credit accumulated depreciation. And if you remember what goes on the income statement, those get zeroed out at the end of every year, right? The expenses reset to zero with closing entries every year. But let's look at how this looks from the accumulated depreciation, the balance sheet side. So you've got this equipment, you know, I like my T counts, and you've got accumulated depreciation. You've got $17,000 in the equipment. So here we go, we've got the balance sheet has equipment in it, and the accumulated, less the accumulated depreciation. So gives you that net book value. So remember we talked about that in the previous slide. You've got the value of the asset minus the accumulated depreciation on the asset gives you the book value, what it's worth to you. So right now, the equipment's worth $17,000 to me because that's how much I paid for it. But after a year of using it, I have the depreciation entry, right? So $17,000 less the $3,000 in accumulated depreciation because it's debit depreciation expense, credit accumulated depreciation. So here's that credit. So after the first year, that equipment is really worth to me $14,000. And that's what shows up on my balance sheet because you want it to show up as what is its true book value to you. After a year of using it, it's worth $14,000 to me. It's always going to be worth $17,000, or at least that's always going to be what I paid for it. But remember, the historical cost principle says you record an asset for what you paid for it. So I can't hit the asset directly. Like I can't credit the asset itself. Instead, what I do is I use this accumulated depreciation account to net against the asset to bring the value down, right? Because I paid $17,000 for that. That's what it has to stay on my books for. All right, but this accumulated depreciation account helps bring the value down. So let's look at year 2 here. So the equipment's still worth $17,000. That doesn't change. But year 2 comes along. Debit depreciation expense, credit accumulated depreciation. So there you go. Now you're at $6,000 because it accumulates. It is a balance sheet account. It doesn't zero out. The depreciation expense zeroes out, but accumulated depreciation lives with the asset it is depreciating. So now it's $17,000 less the $6,000, right? It's accumulating. So here we go. Your net book value is 11. Do the same thing year 3, right? Now we got a third year of depreciation. We're at 8,000. Year 4, there you go. We're adding it along, and year 5. And if you notice, where do I stop? I stop at the residual value. I don't depreciate past that residual value, and that is a rule. And the reason we don't do that is because that's how much we calculated we want the asset to be worth on our books at the end when we're done using it, because we're going to sell it for that amount. That's what we're saying it's worth. It's worth $2,000. So here you've got the $17,000 less the $15,000 of accumulated depreciation, and there you go. There's that residual value. It's worth $2,000. Okay, go on to the next video.